The same luxury brands preaching sustainability in their $100 million ad campaign pays less in taxes than the barista making your morning coffee, while you're being sold empowerment, equality, and environmental consciousness wrapped in a $15,000 handbag. These corporations are orchestrating some of the most elaborate tax avoidance schemes in modern capitalism. The luxury industry generated over $300 billion in revenue last year, yet some of the biggest names pay effective tax rates in the single digits. Today, we're revealing 15 shocking ways luxury brands dodge taxes while positioning themselves as moral authorities. Let's get started with number 15. At number 15, we have the Dutch sandwich technique, and no, this isn't about tulips and cheese. This is one of the most sophisticated tax avoidance structures used by luxury conglomerates, and it works like financial origami. Here's how it operates. A luxury brand establishes a subsidiary in the Netherlands, which acts as a conduit company. Royalty payments for brand licensing and intellectual property flow through this Dutch entity to another subsidiary in a tax haven like Bermuda or the Cayman Islands. The Netherlands doesn't charge withholding taxes on royalty payments to many countries, making it the perfect middle layer. The result? Billions in profits are funneled through Amsterdam offices that sometimes consist of nothing more than a mailbox and a part-time accountant. Companies using variations of this structure have reduced their effective tax rates to below 5% in some years. Meanwhile, these same brands run campaigns about supporting local communities and fair trade practices. The irony is that the Dutch government has been pressuring companies to stop using these structures, but enforcement remains weak, and the financial incentives are simply too massive for corporations to voluntarily comply. Number 14 brings us to the Irish double. The tax strategy so effective it became legendary in corporate finance circles. Ireland offers a corporate tax rate of just 12.5%, already significantly lower than most developed nations. But luxury brands don't stop there. By establishing an Irish-registered company that claims tax residency in another jurisdiction with even lower rates, corporations can achieve what's called stateless income. This means profits exist in a legal limbo where no country can effectively tax them. Several major luxury conglomerates have used Irish structures to park billions in intellectual property rights. The brand's logo, design patents, and trademarks are legally owned by the Irish entity, and every product sold worldwide pays a licensing fee back to Ireland. These fees are tax-deductible in high-tax countries, reducing the tax burden there, while the income received in Ireland is then funneled to the secondary tax haven. It's estimated that Ireland has facilitated over $100 billion in profit shifting annually across all industries. When confronted, these companies claim they're simply following legal tax codes, which is technically true, but it raises the question of whether legal and ethical are the same thing when you're selling consumers on your corporate values. At number 13, we examine the Luxembourg Luxe, a favorite among European luxury houses. Luxembourg has positioned itself as the Switzerland of tax planning, offering advanced tax rulings that let companies know exactly how little they'll pay before they even set up shop. Luxury brands establish financing subsidiaries in Luxembourg that provide loans to other parts of the corporate empire. The interest payments on these intra-company loans are tax-deductible in high-tax countries, but are taxed at Luxembourg's favorable rates, sometimes negotiated down to less than 1% through special rulings. One major luxury conglomerate saved an estimated €400 million over a decade using Luxembourg structures. The country has a population of just over 600,000 people, but hosts thousands of corporate entities managing trillions in assets. These aren't operational headquarters with thousands of employees. They're legal structures designed purely for tax efficiency. The European Commission has actually ruled some of these arrangements as illegal state aid, ordering companies to pay back taxes. But the amounts recovered represent a tiny fraction of what was originally avoided, and new structures simply emerge to replace the old ones. Number 12 reveals the Swiss safe, and Switzerland's role goes far beyond luxury watches and chocolate. The country offers special tax deals for foreign companies through its cantonal system, where each of Switzerland's 26 cantons can set its own corporate tax rates and negotiate special arrangements. Luxury brands establish regional headquarters in places like Zug or Geneva, benefiting from effective tax rates that can drop below 8%. But the real magic happens with something called a principal structure. The Swiss entity is designated as the principal entrepreneur for entire regions, taking on supposed risks and functions that justify allocating a large portion of global profits to Switzerland. One luxury watchmaker reported that over 60% of its global profits were attributed to its Swiss operations, despite the majority of its sales occurring elsewhere. Switzerland also offers extensive tax treaties with other nations, allowing companies to minimize withholding taxes on dividends, interest, and royalties. The country's banking secrecy laws, though weakened in recent years, still provide a level of financial privacy that makes tracking money flows challenging. When these brands market their Swiss heritage, they're not just selling craftsmanship, they're operating from one of the world's most sophisticated tax optimization jurisdictions. At number 11, we have the Singapore sling, representing Asia's answer to European tax havens. Singapore has transformed itself into a luxury goods hub, not just for consumers, but for corporate structures. The country offers a territorial tax system, meaning income earned outside Singapore isn't taxed there, combined with extensive tax treaties and special incentives for regional headquarters. Luxury brands route their Asia-Pacific operations through Singapore, consolidating profits from high-growth markets like China, Japan, and Korea into Singaporean entities. The corporate tax rate is 17%, but with various incentives and exemptions, effective rates can fall into single digits. One European luxury house shifted its entire Asian intellectual property portfolio to a Singapore subsidiary, allowing it to collect licensing fees from the region's booming luxury market while paying minimal taxes. Singapore also offers advanced pricing arrangements where companies can negotiate their transfer pricing methodology with tax authorities in advance, providing certainty and optimization. The country processed over $400 billion in luxury goods trade annually, much of it flowing through corporate structures designed to minimize tax leakage. What makes this particularly galling is that many luxury brands have publicly supported higher taxation and wealth redistribution in Western countries while simultaneously architecting their Asian operations to avoid those very obligations. Number 10 exposes the Monaco maneuver, where the world's second smallest country plays an outsized role in luxury tax planning. Monaco has no income tax for residents and no capital gains tax, making it a magnet for luxury brand executives and shareholders. While companies can't typically establish operational headquarters there due to EU regulations, the principality serves a different function in the tax avoidance ecosystem. Wealthy shareholders and founding families of luxury brands establish residency in Monaco, meaning dividends and capital gains from their stakes in these massive corporations are entirely tax-free. One prominent luxury dynasty has several family members residing in Monaco, collectively avoiding hundreds of millions in personal income taxes over the decades. This creates a perverse incentive structure where the owners of luxury brands benefit from tax avoidance at the personal level, encouraging aggressive corporate tax strategies that maximize distributions to shareholders. Monaco's population of 39,000 includes a disproportionate number of luxury industry billionaires, and the principality generates municipal revenue through other means like casinos and tourism. The country has been criticized by the OECD for facilitating tax avoidance, but with the protection of France and its attraction to the ultra-wealthy, reform efforts have been minimal. When luxury brands talk about giving back to society, their primary beneficiaries are often living in a jurisdiction specifically designed to give back nothing. At number 9, we discover the Delaware Dodge, showing that America isn't exempt from enabling luxury tax avoidance. Delaware has become the domestic tax haven of choice for U.S. operations, with over 1 million corporate entities registered in a state of fewer than 1 million people. Luxury brands use Delaware for several advantages. No state corporate income tax on goods and services provided outside Delaware, no sales tax, strong privacy protections for beneficial owners, and a specialized chancery court that provides predictable and business-friendly legal outcomes. Many luxury brands structure their American operations through Delaware holding companies that own intellectual property, collect royalties, and manage financing arrangements. Because Delaware doesn't tax intangible income derived from out-of-state sources, companies can route trademark and patent licensing fees through Delaware entities without state-level taxation. One luxury fashion house reported that its Delaware subsidiary, with just 3 employees, generated over $200 million in annual licensing revenue. The state has refined corporate law over more than a century to be maximally favorable to business interests, creating a race-to-the-bottom dynamic where other states struggle to compete. When luxury brands drape themselves in American flags and talk about their commitment to the U.S. market, they're often operating through structures specifically designed to minimize their contribution to American schools, infrastructure, and social programs. Number 8 reveals the Bermuda box, where this tiny Atlantic island has become a cornerstone of luxury tax architecture despite having no corporate income tax at all. Bermuda serves as the ultimate destination for profits in many corporate structures, particularly for insurance and holding company arrangements. Luxury brands establish Bermuda-based subsidiaries that own intellectual property, collect licensing fees, or provide internal insurance services to the broader corporate group. Because Bermuda has no corporate income tax, profits accumulated there face no local taxation, and the island's extensive tax treaty network helps minimize withholding taxes on income flows. One luxury conglomerate reportedly held over $8 billion in a Bermuda subsidiary, describing it as permanently reinvested foreign earnings that would never be repatriated and taxed. The island's regulatory environment is sophisticated enough to satisfy international legitimacy requirements while remaining fundamentally oriented toward tax minimization. Bermuda's entire economy is structured around offshore finance, with financial services representing over 25% of its GDP. When Hurricane Nicole devastated parts of Bermuda in 2016, it barely affected the luxury brands with corporate structures there because most entities exist only on paper, with no physical operations that could be damaged. These brands will sponsor disaster relief campaigns and talk about community resilience, but their Bermuda entities contribute virtually nothing to the jurisdictions where their products are actually made and sold. At number 7, we examine the Cayman concealment, perhaps the most notorious tax haven in the world and a favorite of luxury investment structures. The Cayman Islands hosts over 100,000 registered companies, despite having a population of only 65,000, and it's a key jurisdiction for private equity firms and investment funds that own or invest in luxury brands. The islands impose no corporate income tax, no capital gains tax, no property tax, and no payroll tax, making them ideal for structuring ownership. Many luxury brands are ultimately owned through layers of Cayman-registered investment vehicles, allowing investors to realize gains from luxury's boom without tax consequences. The jurisdiction is also used for holding company structures where a Cayman entity sits atop a global corporate pyramid, collecting dividends from operating subsidiaries worldwide while paying no tax on that income. One investigation found that a single building in the Cayman Islands, Ugland House, served as the registered address for over 18,000 companies, including entities connected to several luxury conglomerates. The Cayman Islands government generates revenue through company registration fees and financial services licenses rather than taxation, creating an incentive to maintain secrecy and facilitate avoidance. Despite repeated international pressure and blacklist threats, the Caymans have implemented only cosmetic reforms while preserving the fundamental tax-free nature that makes them so attractive to luxury capital. Number 6 uncovers the British Virgin Islands bypass, another Caribbean jurisdiction that punches far above its weight in luxury tax planning. With a population of just 30,000, the BVI hosts over 400,000 active companies, making it one of the most company-dense places on Earth. The jurisdiction offers zero corporate income tax, no capital gains tax, and strong privacy protections that historically made beneficial ownership nearly impossible to trace. Luxury brands and their investors use BVI companies for everything from yacht ownership to real estate holdings to intermediate holding companies in complex corporate structures. The BVI's advantage over other havens is its flexibility and low maintenance requirements. Companies can be established in days with minimal ongoing compliance, and bearer shares were legal until recent international pressure-forced reform. One luxury yacht manufacturer used a network of BVI entities to structure the ownership and financing of $100 million vessels, allowing wealthy buyers to minimize taxes on purchases and operation. The European Commission has identified the BVI as facilitating aggressive tax planning that costs member states billions annually. Despite this, enforcement remains weak because unraveling BVI structures requires international cooperation that's difficult to coordinate and because the territory enjoys British protection. When luxury brands talk about transparency and ethical business practices, their connection to BVI structures represents exactly the opposite, a deliberate choice to operate through one of the world's most opaque jurisdictions. At number 5, we explore the Panama Papers playbook, named after the massive 2016 leak that exposed how luxury players use Panamanian law firms to establish offshore structures. Panama offers a combination of tax advantages and secrecy that made it ideal for hiding assets and ownership. While the papers leak embarrassed many corporations and individuals, the fundamental structures remain legal and widely used. Several luxury brand executives and major shareholders were named in the Panama Papers, revealing offshore entities that owned everything from super yachts to real estate to art collections. Panama's financial system allows for the creation of anonymous corporations where beneficial ownership can be obscured through nominee directors and bearer shares, though recent reforms have theoretically tightened these rules. The country also serves as a ship registry for luxury yachts, offering flag of convenience services that provide tax benefits and regulatory flexibility for vessel owners. One luxury brand's former CEO was found to have a complex network of Panamanian entities that controlled over $100 million in assets, none of which appeared in simplified public disclosures of his wealth. What made the Panama Papers so revealing wasn't just the tax avoidance, but the hypocrisy. Individuals who publicly advocated for higher taxes and social responsibility were privately using some of the world's most aggressive avoidance structures. The luxury industry's response was largely to claim these arrangements were legal and created for estate planning rather than tax avoidance, a distinction that satisfies lawyers but not the general public. Number 4 examines the Malta mystery, a small Mediterranean nation that's become a crucial link in luxury tax chains. Malta offers some of the EU's most favorable corporate tax arrangements through a unique refund system. Companies pay a standard 35% corporate tax, but shareholders can claim refunds of up to 30%, reducing the effective rate to just 5%. Luxury brands establish Maltese subsidiaries for intellectual property management, distribution rights, or financing operations, taking advantage of both the low effective rate and Malta's extensive EU and international tax treaties. The country has faced significant criticism from the European Parliament for facilitating aggressive tax planning, with one report estimating that Malta's tax structures cost other EU nations over 15 billion euros annually. One luxury conglomerate established a Maltese entity that licensed brand trademarks across Europe, funneling hundreds of millions in royalties through Malta at the favorable rate before distributing profits to shareholders with the refund benefit. Malta also offers schemes for wealthy individuals, including a citizenship by investment program that's been used by luxury industry figures to gain EU mobility while maintaining favorable tax treatment. The assassination of journalist Daphne Caruana Galizia in 2017, who was investigating corruption and tax schemes in Malta, highlighted the darker side of these financial arrangements. Despite international pressure, Malta's economy has become so dependent on financial services that meaningful reform would require completely restructuring the country's economic model. At number 3, we confront the transfer pricing trick, the most widespread and subtle form of luxury tax avoidance. Transfer pricing governs how multinational corporations value transactions between their own subsidiaries in different countries, and it's ripe for manipulation. Here's how luxury brands exploit it. They establish a subsidiary in a low-tax jurisdiction that legally owns the brand's intellectual property, trademarks, and design patents. Operating subsidiaries in high-tax countries like France, Germany, or the United States then pay hefty licensing fees to use these assets. These fees are tax-deductible in the high-tax countries, reducing taxable income there, while the receiving entity in the low-tax jurisdiction pays minimal taxes on the licensing revenue. The challenge for tax authorities is that intellectual property doesn't have an obvious market value, giving companies enormous latitude to set prices. One luxury fashion house was investigated for charging its European operating companies licensing fees equivalent to 15% of revenue, effectively eliminating most taxable profit in high-tax jurisdictions while accumulating billions in low-tax havens. The OECD has attempted to standardize transfer pricing rules through its base erosion and profit-shifting initiative, but enforcement is inconsistent, and companies employ armies of transfer pricing specialists to design defensible but aggressive structures. A study found that multinational luxury corporations shift approximately 40% of their profits to low-tax jurisdictions through transfer pricing and related techniques. When you buy a luxury product, a significant portion of the price you pay is designed not to compensate for materials or craftsmanship, but to create tax-deductible expenses that shift profits across borders. Number 2 exposes the brand buyback bonanza, a financial engineering technique that prioritizes shareholder wealth over tax contributions. When luxury brands generate substantial profits, they face a choice: reinvest in the business, pay dividends, or buy back their own shares. Buybacks have become increasingly popular because they boost earnings per share and stock prices, enriching executives with stock-based compensation and shareholders alike. But here's the tax angle. In many jurisdictions, capital gains from selling shares are taxed at lower rates than dividend income, and investors can time when they realize those gains for optimal tax treatment. Additionally, companies can often deduct the interest on debt they take on to fund buybacks, creating a tax benefit at the corporate level too. One luxury conglomerate spent over 12 billion euros on share buybacks over a 5-year period, more than triple what it spent on employee wages and benefits increases. This massive capital return to shareholders occurred while the same company was closing factories, cutting costs, and reducing its workforce. The buybacks enriched a small group of wealthy investors, many based in tax havens or low-tax jurisdictions, while the company's effective tax rate fell due to increased interest deductions. Critics argue that this represents a form of financialization where luxury brands become more focused on extracting value for shareholders through financial engineering than creating value through better products or supporting workers and communities. When these companies talk about stakeholder capitalism and shared prosperity, their actual capital allocation tells a very different story. Finally, at number 1, we have the most brazen technique of all, the values-virtue signal, where luxury brands weaponize moral messaging to distract from tax practices. This isn't a legal structure. It's a strategic approach that deserves the top spot because it ties everything together. Luxury corporations have dramatically increased their spending on corporate social responsibility campaigns, sustainability initiatives, diversity programs, and social justice messaging. But these efforts cost a fraction of what aggressive tax avoidance saves them. One major luxury house spends approximately 50 million euros annually on its environmental foundation and widely publicizes this commitment. But through the tax strategies we've discussed, it avoids an estimated 3 billion euros in taxes that would fund public environmental programs, healthcare, and education. The messaging is sophisticated. These brands position themselves as leaders in addressing climate change, inequality, and social issues, gaining customer loyalty and premium pricing power, while simultaneously lobbying against tax reforms and maintaining structures in every major tax haven. It's a form of moral arbitrage where the reputational value of virtue signaling exceeds the cost of the actual programs. Research shows that 72% of luxury consumers say a brand's values influence their purchase decisions, justifying premium sustainability marketing spending. But when pressed on tax practices, these same companies claim fiduciary duties to shareholders and argue that tax minimization is not only legal but obligatory. The cognitive dissonance is staggering. A brand will produce a $30 million campaign about empowering women while maintaining structures that deprive governments of funding for maternal health, childcare, and education. They'll create limited edition products supporting ocean conservation while routing profits through island tax havens. They'll partner with celebrities to promote racial justice while fighting country-by-country tax reporting that would reveal how little they contribute to developing nations where their products are manufactured. This isn't just hypocrisy, it's a business model where morality becomes a marketing input rather than a genuine commitment. So there you have it. 15 ways luxury brands systematically avoid taxes while selling you the idea that they're making the world better. From the Dutch sandwich to the values virtue signal, these techniques represent billions in lost public revenue that could fund healthcare, education, infrastructure, and the very social programs these brands claim to support. The luxury industry has perfected the art of having it both ways. The benefits of stable societies, educated workforces, and public infrastructure while contributing as little as possible to maintaining these systems. Next time you see a luxury brand's empowerment campaign or sustainability report, remember that these same companies employ more tax strategists than they do environmental scientists. The most expensive thing they're selling isn't a handbag or a watch, it's the illusion that purchasing from them makes you part of something meaningful. If this video opened your eyes to how luxury brands really operate, make sure to hit that like button to help others discover this information. Subscribe to the channel for more content that exposes the truth behind glossy marketing and corporate spin. Drop a comment below telling me which tax avoidance technique shocked you the most, or share your own experiences with luxury brand hypocrisy. And please share this video with anyone who needs to understand that the luxury industry's moral authority is as carefully constructed and hollow as their tax strategies. The more people who understand these practices, the more pressure we can create for genuine reform. Thanks for watching, and I'll see you in the next video.